Hi, this is Damon Pistolka, host of The Faces of Business, where I talk with interesting people, sharing life and business experiences to entertain, engage, build community, and provide information to help others succeed. If you're interested in learning more about one of our guests or how we are helping business owners generate wealth and build businesses they can sell or succeed at Exit Your Way, you can find more information on our website, exityourway.com, or by contacting me directly, Damon at exityourway.com. I hope you enjoy the show. All right, everyone. Welcome once again to Faces of Business. I'm your host, Damon Pistolka, and with me today, I have that guy right over there, Andrew Cross. Andrew, glad to have you today. We'll go backwards, isn't it? It's like I was going to point at you. Yeah.
I'm with stupid.
Yeah. That's about it, isn't it? That's about it. Well, today we got an interesting topic because we're going to be talking about how interest rates affect business value. We're going to cover that a bit. We're going to cover some of the changes it's really made in the business sale, the selling of businesses, and some of the things we're seeing in the market and the economy because of it. So, Andrew, let's get started.
Yeah.
So when you started out selling businesses a few years ago, this was not in such a good time. And you had some similar situations to what we're starting to experience now. So talk about that, because then I think that'll roll us good into what we're seeing with such a dramatic, for the last decade or so, rise in interest rates.
Yeah. I got into the M&A business in 2009 and spent the first year getting my knowledge, which is good because I didn't know what I didn't know. And a lot of people were getting out of the M&A business at that time. As you know, that was the big financial crisis. And it was... it was a disaster. I think, in retrospect, it turned out to, and I didn't do it on purpose, turned out to be a good time to get into the business. But at that time, there was no any bank lending. Everything had frozen up, the bank failures and all that kind of stuff. So deals really slowed down. Private equity was still fairly active and wanting to be active, but even private equity groups and investors, they still leverage businesses and use business loans. So at that time, in order to get any deals done, and the activity sort of went down to smaller deals. And if you were going into smaller businesses where you have more flexibility, they're not quite as expensive. You can also do you're free to do more creative financing strategies, seller financing and earnouts and these kind of things that help. But at that time too, a lot of the medium-sized or larger businesses just bunkered in and just wanted to wait it out, not going to sell. And so activity was way down. So looking ahead to today, and since then we've had 10 years of cheap capital. And its interest rates have been at zero. The government's been flooding money into the market during COVID crises and stuff like that. And for the most part, that's unprecedented that buyers have had that kind of access to capital for the last almost 10 years. And so it's been a seller's market. It's like there's a lot of dry powder out there from the equity groups. They had access to cheap capital, and and they couldn't even spend what they had. Mm-hmm. So, and then what the net result was, higher multiples.
Yeah,
and here we are today. Now, very, very quickly that whole table's completely flipped, and we definitely are seeing the effect. Deal flow has gone down.
Yes,
a lot.
It has. It really has. In the first half of the year, I haven't looked at the latest statistics, but I know that every article I read, they say it's down, and it's getting more. Buyers are getting much more selective. Mm-hmm. and some of the other things we'll discuss in a minute, that and valuation has been affected. We'll
Mm-hmm.
talk about that, and then also terms of the deal and how they're structuring the terms of deals has been affected.
Mm-hmm.
So when the interest is increased, the government's doing this to try to slow down the economy. What are some of the things that business owners really need to be thinking about if they're considering the sale of the business in a time of interest rate increase? I mean, what are the things that they're going to have to come to the realization or think about when
Mm-hmm.
they're doing that, in terms of value, in terms of what they should be doing to prepare? So give me a couple general things, and then we'll go into some more specific.
Well, I think that, and business owners need to understand the capital market and the cost of capital. And, this is that's gone way up. They're going to feel that too, because, in being able to finance their business, cost of materials is going up, cost of labor is going up, so that we are under inflationary pressures. It does seem that businesses are still chugging along, and I think they're obviously they're going to be participating in the inflation with increased costs, and so sales will probably increase, and that effect whether margins do or not. It's we have to be seen, but it's definitely, they've got headwinds that they're facing. But the cost of capital, at the end of the day, they just have to understand. We just make some assumptions. When you're doing valuations, you make assumptions that the way the business will be valued based on a market price. The market price is driven by, generally a buyer, will do an asset sale. And it's not always the case, but, you can make pretty good assumptions, and valuators do that it's going to be an asset sale, and the buyer's going to come in, leverage the business cash flow to buy the business with the cheapest amount of capital they can. And the cheapest capital, of course, is friends and family.
Yeah.
And then some people do that. Again, that's where it's that flexibility you get on the smaller deal. And the next cheapest form of capital is, government-backed loans, SBA loans, which have now gotten increasingly more expensive. And then cost of capital beyond that, you're going up into venture capital, equity groups, investors, who you expect fairly high rates of return on their investments in there. So, and they also leverage with the banks, so they don't have the access that they used to. Although these are investors looking for alternative returns. So, an equity group, we'll have investors who put money into that, and they can access that cash, but they're going to want to see higher returns, because today they can go take that same amount of money that they're investing in these small, medium businesses and private equity and put it into T-bills and make 7%. That's the safest thing you can do.
There's options. You're going to have other options.
Yeah, they definitely have other options. And they're because that's all they are investors.
That's a good point, because that one of the things that I didn't think about until you said that was really that the rising interest rates make other options outside of investing in businesses more attractive, because a lot of money was going into the purchase of businesses or real estate simply because low interest rates, and those things, the values of those appreciating so fast because of the low interest rates was driving a lot of investment into businesses and real estate.
Yep, absolutely. So, I mean, it's definite. It at the end of the day, to get a deal done, it will have an effect on purchase price.
Yeah,
prices are going to have to come down because the cost of buying a business has gone up.
Yeah,
and I guess as a business owner, that's what they need to recognize, that in order to kind of get the what the return they want on their investment, they may have to work on internal organic growth and mechanisms to to get past that because multiples are dropping.
Yeah, that's true. Because if you just look at last year, and I don't quote me on the numbers because I did this a while ago, but weren't the interest rates like this time last year, a year ago, like 0.5% or something like that? And now I don't even know what it is, 5%.
5%, yeah.
It's 5%.
Well, for example, like a typical SBA loan now is running about 9.5 to 10%.
Okay.
And and for the last 9 years or 7 years, it's been around 5 and 6.
Yeah. So 5 to 6.
So what does that mean, to the seller? Just look at it from the bank's perspective. Okay, I want to buy this business. The bank's going to underwrite it. You're going to look at your cash flow, and if you had, $1 billion in cash flow, okay, that's you're not going to get as much for that as you did in the past because that cash flow has to pay that debt service. So so it's pretty good math to figure out. A typical loan is 10 years. Amortized, 80% down. Or they're going to finance 80%, probably 20% cash down. That's a very typical asset sale deal that the banks will finance. And so, if you take your purchase price and you can figure out what your annual, expense, principal plus interest payments are going to be, you have to have enough cash flow to cover that.
Yeah.
And that's so, in order to get that coverage, 1.5 times coverage is, what a typical bank's going to want to see. You got to have enough cash flow to cover that. And it's a lot. It's a pretty high hurdle to get over now when it's at 10%.
Yeah. When I wasn't quite this high when I did a rough calculation, I don't know, 2-3 months ago. And it was something like it went from on per $1 million of business price. And I was kind of going, okay, on using 1.5 debt service coverage ratio, how much cash flow do I need to support $1 million in business value? And it's just rough as heck, right? But it like from last year, 1 year ago to then, it was 22% difference, I think. So if each million was, if I remember right, it was like 180,000, and now it's like 220,000 that it needs to support $1 million in value. So I mean, this is significant for business owners that were expecting that their business was going to sell in a time of low interest because they just dropped the price of their business by that much, right?
Yep, absolutely. I mean, that's what the market will bear, right?
Yeah.
And the cost of capital has an effect on that.
Yeah.
So, I mean, so it's where buyers, sellers really need to understand just that, it isn't, I'm going to sell you this car and we can put some arbitrary value on it. It really comes down to it, step back and look at the amount of cash flow the buyer will have available to support the lending, and they have to, they got to have enough left at the end of the day to pay themselves and pay down their loan, so that they're building equity, in a reasonable amount of time, which is typically, it should be at least 3 to 5 years. You should have the business that supported building that equity, but if you don't have enough to do it, you just.
Yeah. And one of the things I was just thinking too, and help me with this. So if I'm looking at this, and I know when they're figuring loans, they look at how much growth capital you need as well. And if you need a bit of growth capital to do this too, the increase in interest rates have hurt you there too, because it's going to take you, it's going to cost you more interest on all the growth that you need to fund.
Yeah. Well, and that's, working capital that is going to be required after the transaction, and the working capital you need to have on hand to run the business, that will go, that hasn't changed. But you're correct. You're going to have to provide that. The seller will have to provide that to the buyer, enough working capital kept in the business And that means current assets, anything you can turn to cash in the next, 90 days.
Yeah.
To keep the business running. But, sellers miss that, oh, I'm going to get $1 million for my business, just for example. Oh, but, the equity in the business is the cash you have in it too, and the receivables and all that kind of stuff. So yeah, the selling price might be $1 million, but the buyer's not going to buy your cash, but they are going to want working capital in there, and it could be $200,000, on $1 million transaction.
Yeah.
So
it makes a difference.
It makes a difference, and really at the end of the day, it's cash that you're leaving in the business as working capital. So you can say maybe I'm not getting $1 million, I'm getting 800,000. It's really about what your net after all these things are done. Of course, that's
a good money. That's a good money. That's a good point, because that money, if you're optimizing your working capital and driving that down prior to the sale, that actually helps you net more out when you go to sell the business. So if you can reduce your inventory levels and still be growing and running the business the same way, if you can reduce your AR and increase your AP a little bit to really reduce the total amount of capital in the business, that will help you net more from the sale.
Mm-hmm.
And it will reduce the buyers, just their I guess risk, because they would have to fund more working capital in the future. Not necessarily the initial part that you have to, but as they grow, the working capital is more expensive per dollar they've got to put into it. So
yeah, that's correct. And again, going to smaller deals, this is one of the areas where a seller can have some flexibility. A bank is going to probably require the seller to provide working capital, but also, because they're conservative, they're going to require the buyer to have a line of credit, which is going to be quite a bit, at least a revolving line of credit, because they want to be over covered as far as working capital goes, and those revolving lines are pretty expensive now too. So
so it's hurt their revolving line cost too.
Yeah. But if you do a sale without a bank, you can negotiate the working capital and that kind of stuff, and that, like you said, and prepare for that transition. Whereas you don't have to. That's that flexibility. And if I think the biggest difference is today, and this has really happened in the last 6-7 months. If you want to sell your business, you're going to have to look at these kind of working around the bank, doing more of your own seller financing, creating your own, providing capital, and that kind of stuff. Just not only to get a little bit more money, but also to get the deal done.
So the one of the things that really, as you were bringing this up earlier, was the interest costs are cutting, are actually reducing future returns for investment owners. So how much is that hurting? I mean, because I know sophisticated investment buyers, they're looking at future earnings, because they know they've got to grow the value of the business, and that's how they make their total return, right? I'm going to buy it right today, but that growth and getting it out there and increasing that value like you want is really where they make sometimes the lion's share of their money. So do you think that this is pressuring business sellers to have a higher growth rate during this time, just to get deals done? Because the private equity people, or people that are sophisticated investment buyers, they're getting more picky about deals, just because if inflation or the interest rates are continuing to go up, it's going to just cut their returns back even further.
Yeah. Well, I think that probably depends. I mean, and also, in this climate too, high growth can be expensive, because you got to fund.
Yeah, that's true.
Growth, so you're going to get more working capital, and there are, all buyers are different. They're more conservative funds that really just want good, steady returns. They're not really interested in high growth companies, and there are others that are looking for high growth companies because they have vehicles of financing to be able to support that growth, and get returns. But it's not always the core of their strategy to have a company that's growing. But it's really all about the EBITDA, the margin. So and you've got to show that it's repeatable. You can transition it, and that you have historically been meeting those margins, and can continue to do that into the future. I think that's going to be the most, that's going to be the most sought after businesses right now too. It is. So
that's a good point, because I was just writing a note as you said that is. I would think that if a business is able to maintain or increase their margins as a percent of revenue in the same time now that we're seeing increases in interest rates, that has to be a big benefit for them.
Yeah. Of course, it depends on the business too. And you just want to, the buyers are pretty savvy out there. They know what the competitors are doing. They want to see, are you above average, on your margins or below?
That's true.
Can you, and can you navigate through these headwinds in the economy? Can you raise your prices and still keep your sales level up? Can you still keep delivering those margins and pay your, increase, keep your management team, your people in place, because you're going to be paying them more and everything. So, and the buyers though are going to be looking for, that's one thing too. It really depends on what industry you're in.
Yeah, that's true. That's true, because
they're going to be looking for some investments that are, probably there's going to be more looking for safe harbors.
Yeah. Well, you think about that and you go things like manufacturing, where we play a fair amount, manufacturing that's capital intensive, like, sophisticated aerospace machining or something like that, where you're dumping $1 million+ into each machine that you bring in, that kind of stuff, that has to really hamper the sale of those businesses.
Yeah, it does. And it's expensive. There's high barriers to get in those types of businesses, but investors may be looking for boring businesses, insurance, services, healthcare, we don't see, I think there's a fair bit of activity in there as well, but
okay.
Yeah.
So what are you thinking we're going to see 6 months out from now? Do you think we're going to, what should people that are contemplating the sale of their business be really preparing themselves for? This
isn't, it's not really a recession. There is a pullback, but there is still a big appetite to purchase businesses, but the right kind of businesses. So I think, basically adjust your expectations, know what you're gonna, and look ahead to see what you can get a valuation done, from something like that. So where you're at. And then you can set up a way to target, kind of where you want to exit. It's not going to be as much as you think, but, and that's one of the big things in the sale of businesses is timing.
Yeah.
Timing is everything. And, it's not, the one thing you really aren't in control of is to say, I would like to sell my business when I'm 60.
Yeah.
You're doing that. It's because you have no idea what it's going to be like then. Yeah. Sell it, when you get a good return on your investment. And if that means now or sooner than later, then fine.
I've got one question, because I was thinking about this as we had some conversations today with some business owners. So if we're talking about creative deal financing, right? We really have to figure out some creative ways to finance deals. Have you seen it before where someone would say, I've got a manufacturing business and I've got equipment loans. Have you ever seen it where if my equipment loans today, if I got my equipment 2 years ago and I got a 5-year loan on my equipment, I got it at a good interest rate, right?
Yeah.
Have you seen it where rather than pay that loan off, that they somehow transfer that? I don't, not do that.
That's a really good question. And because there may be some equity in that. But I think commercial leases and those kind of things, it is. It's just like in your home. People aren't selling right now because they're sitting on, they got a 2% interest rate, and interest rates are now 8 or 9. So they're not selling, and whether it's, those are not transferable. Whether they are depends on the contract. If it is,
all right.
If it is, there's, that'd be something that, you bring a good point. You may have something of value there.
Exactly. That's what I'm thinking, because if you have machines with excess capacity or something, and I've got commercial leases with those, is it good for some owners to retain ownership of machines and lease them back at the rate that they could to the new buyer, because my lease costs are lower for the new buyer?
It's probably that would be a good way to look at that. In a similar way, similar fashion, that's how leases are dealt with too. So, I mean, if if you're a real estate lease, if you're sitting on, a very good competitive rate and you've had it and you've got an option for another 5 years or something, could be value to that. Mm-hmm. But again, landlords are pretty savvy, and usually their contracts are written if there's a change in control.
But
no,
it's something worth looking at. Equipment, though. I mean, if you got a lot of equipment and you're locked in with a good rate, it might be something that's well worth it to figure out a way to reduce interest costs for you and the buyer.
Yeah.
I don't know. It just came up as we were talking about it here.
Yeah.
So it's taking a lot more thought into getting deals done when the financing costs are higher, isn't it?
Exactly right. Yeah.
So what exciting things do you think the interest rates have caused in the business sales?
Good things,
exciting things that go, holy heck, this is awesome.
I think it's exciting to be in the finance business. Those services are still doing pretty well. I'm quite surprised how resilient the market is being. They're buying, hell be damned, paying, they're overcoming or paying the interest rates anyways. Deals are getting done. Mm-hmm. So I think generally, especially in the small, medium businesses, that I think the economy is pretty good, for that. Certainly the demand there, and but it is definitely more technical and difficult to navigate around an exit if you're coming to that point. My experience was from 2009 was that business owners bunkered in and waited it out, and that wasn't really that a lot of them ended up, they just lost equity in the business, and they got they went through a decline too, because generally that's how it goes. And I think bunkering in and waiting, it might work, but you could still, at the end of the day, you may have much less of a business to sell by the time you get on the other side, and you'll be a few years older too.
Yeah. Well, the one thing that I'm wondering is the increase in interest rates weeding out a lot of the businesses that were probably getting considered before but can't be considered now? Mm-hmm. So do you think the best businesses have more competition to buy them?
Yeah, I think there'll be some cleansing. There'll be throughout, and I think that's across industries, not even to more specific.
Yeah,
I think like the probably the most you can see it, right, is in the hospitality, restaurant, service industry. It's there was a lot. I mean, COVID, they kept a lot of people around, but the interest rates are flushing out a lot of them, and a lot of closures. And then, those kind of industries, that's what they do. They'll pop back up. And then, and how do they pop back up? People are putting capital into it.
Mm-hmm.
So,
yeah. No, it's interesting times for sure.
But, I think the target in that too is, and one of the biggest expenses that any business has is the real estate. And real estate prices have been, if you have a business that's, is paying 20 or 30% of their revenue towards their rent, and that's what was going on. And it's because rent, real estate's high. It's not, the business generate what it generates, but no business should be spending, that much of their revenue towards their rent. So there's an adjustment there, and that'll be good. And there's opportunities that come up.
Yeah.
And that market does need to adjust.
Yeah. Because as you know, you looked at some businesses in the last 12 months that were paying far above, as a percentage, it was normal and for the area, for the type of space that they have, but it was significantly higher than what they should as a percent of revenue. Based on historical.
Yeah. So
well,
as far as that goes, the business, the business is actually paying for the landlord's investment. The business isn't making anything. And that's in the small businesses, that's pretty common. But
well, if you're the owner of the business and the real estate, that's not such a bad thing. But when you're leasing the land from somebody else,
but it'll be interesting. I mean, there's office vacancies and that kind of stuff, and remote work, and there's a lot of pressures. And I think in the long run, not good for real estate people, but better for the overall economy and businesses. More affordable real estate.
So it seems like from our discussion today, one of the things, though, that anyone considering a sale of business should really do is, probably want to, if you've got a valuation last year, you need to get that thing updated at least, because it's going to change. And the second thing is that if you're not growing at least a bit, you might want to look at that and see if you can change that a little bit, because that will help the buyer get more comfort in overcoming any future interest rate.
And I'll definitely caveat that with growth, but profitable growth.
Profitable growth. There you go.
You got to maintain your margins.
That's right. There you go. That's probably the biggest things. Maintain your margins with some growth, and you're probably going to be in the best situation.
Yeah.
Well, Andrew, it was great talking about this, because this has been on the minds of many people in the industry of selling businesses, for sure. If people listening didn't understand, if they saw all the blog posts and everything that are happening about it, they would realize that this is changing a lot of things for business owners that want to exit.
It is, and I do think it's a correction, and I don't think we're going to be going back to those zero interest days. So it's really, and that was an adjustment back in 2009 that people had to realize. And before that crash, everybody was into doing deals and wheeling and dealing, and they thought it would never end. We're really just getting back to baseline.
Yeah.
So there's still value. There's still transactions going on. There's still a market, and buyers want to buy. Or we're getting back more into like the real, what transactions should be for.
That's a good point. That's a good point, because valuations were high, because money was so cheap, and people were tempted to buy less quality businesses because valuations were cheap, and they could stick, money into it and maybe do some fixer upper kind of things, where now they're going to be looking at it and going, we don't want to spend that extra money if we're not going to go down that road. Yeah.
These are, I think the auto industry is having similar trouble. They got new cars that are sitting out there because people can't, they need to bring their prices down, their costs. So, but we'll see how it goes. It's a little different than with the business.
Yeah. Well, thanks for stopping by today, Andrew. And I know people can get a hold of you at the Exit Your Way website and talk to you there, and or email you. It's andrew@exityourway.com if they got questions about this. But thanks for stopping by and talking today.
You bet.
Talk to you later, everyone. And everyone today, thanks for listening. Thanks for always getting in here, putting comments in, and doing that and helping support us. And if you got someone that you think you'd like to have on the Faces of Business, have them reach out to me. Thanks, everyone. Bye.